Welcome to PIP Insight Macro, the economic calendar briefing for the daily Forex news. Today is the 15th of July, 2026. This session has 7 high-impact and 0 medium-impact releases coming up. Let's run through exactly what's on the calendar and what it means for the major currency pairs. Hey everyone, welcome back to PIP Insight Macro. I'm your host bringing you today's daily Forex news. We've got 7 high-impact events on the calendar, and the big story is the yen in focus. Dollar yen, euro yen, pound yen, and Aussie yen are all on our radar. Stick around as we break down what could move these pairs today. Here is the full economic calendar for the daily Forex news. We have 7 high-impact releases due this session. Let me walk you through each key event and what it could mean for the markets. We're watching Core PPI month-over-month data hitting the calendar today, and this is a high-impact release for the US dollar. This report measures inflation pressures at the producer level, stripping out volatile food and energy prices, so it's a direct window into what might eventually flow through to consumer inflation. Central banks live and breathe this stuff. A stronger than expected print could reinforce Fed hawkishness, while a miss might suggest disinflation is gaining traction. Core PPI tracks the monthly change in prices that producers receive for their goods and services, excluding the food and energy components. It's a critical leading indicator for the Fed because producer inflation typically precedes consumer inflation with a lag, making it essential for policy decisions. We're forecasted at 0.3% month-over-month, down from the previous 0.4%. That's disinflation, which is what the Fed wants to see. A beat above 0.3% would suggest sticky inflation and could strengthen the dollar as markets price in a more persistent hawkish Fed stance. A miss below forecast would be dollar negative initially, signaling the inflation battle is being won and potentially opening the door for rate cuts. The recent trend has shown producer inflation moderating, but today's print will either confirm that momentum or signal a pause in progress. Watch for sharp moves immediately on the release and into the European afternoon session, as foreign exchange markets typically see heavier volatility in the first 15 minutes post-data. We're tracking the Producer Price Index month-over-month release today, and this is a high-impact data point for the US dollar. The forecast is calling for a flat reading of 0%, a sharp deceleration from the previous month's 1.1% increase. This inflation gauge is critical because it often signals where consumer prices are headed, making it essential for Federal Reserve policy decisions. The PPI measures the average change in prices that domestic producers receive for their goods and services, essentially capturing inflation at the wholesale level before it reaches consumers. This matters enormously for central banks because persistent producer-level inflation typically translates into future consumer price pressures, which directly influences interest rate policy. A beat above the 0% forecast would suggest inflation remains sticky, potentially supporting a firmer dollar and signaling the Fed may maintain higher rates longer. Conversely, a miss below forecast would indicate disinflationary momentum, which could weaken the dollar as markets reassess rate cut expectations. The previous 1.1% reading showed concerning strength, so today's expected moderating trend would be a relief for the inflation narrative. Traders should watch for the actual print intensity. Even if it hits 0, the composition matters. Are we seeing broad-based cooling or selective weakness? Look for potential volatility spikes at the initial release, with follow-through moves. The Bank of Canada is releasing its monetary policy report today, a critical document that outlines the central bank's economic assessment and forward guidance. This report is a major market mover because it signals the BOC's thinking on interest rates, inflation, and economic growth, all key drivers of Canadian dollar strength. We're watching this closely because it could reshape expectations for Canadian dollar across multiple currency pairs. The Monetary Policy Report is the BOC's official economic assessment published 8 times per year, combining their latest inflation projections, growth forecasts, and policy stance. This matters enormously for Forex traders because it's where the central bank telegraphs its next moves on rates. Hawkish language or higher rate forecasts typically strengthen the Canadian dollar, while dovish signals or rate cuts weaken it. A beat on this report means the BOC is signaling stronger growth or stickier inflation, supporting higher rate expectations, and Canadian dollar appreciation. A miss suggests economic softness or disinflation, which pressures the loonie lower. Given recent global rate cut cycles and Canada's economic headwinds, the market is hypersensitive to any shift in the BOC's tone. Traders should watch for specific language around the neutral rate, inflation dynamics, and the timing of future policy adjustments. Price action around key technical levels in the affected pairs typically accelerates immediately after release, with volatility often sustaining for hours as positioning adjusts to the new forward guidance. The Bank of Canada is set to announce its interest rate decision today, and this is one of the most closely watched economic events for the Canadian dollar. The BOC's policy stance directly influences capital flows into Canada and affects how attractive Canadian dollar-denominated assets are to global investors. We're going to break down what this means for your major currency pairs and the price action you should be monitoring. The BOC rate statement tells us whether Canada's central bank is holding, raising, or cutting its benchmark overnight rate, the foundation for all borrowing costs in the Canadian economy. This decision matters enormously because interest rates are one of the primary drivers of currency valuation. Higher rates typically attract foreign investment seeking better returns, strengthening the currency, while rate cuts tend to weaken it. A rate hold signals the BOC is comfortable with current policy. A surprise hike demonstrates hawkish inflation concerns and typically sends the Canadian dollar sharply higher, and a cut signals economic softness or a shift toward accommodation, which usually weakens Canadian dollar. The accompanying statement and forward guidance are equally important. Traders scrutinize language around future rate paths and economic outlook to gauge whether more moves are coming. If the BOC beats expectations with a more hawkish tone or signals higher for longer rates, we'd expect Canadian dollar strength across the board. Conversely, a dovish surprise or pivot toward easing would create selling pressure. Watch for volatility spikes on the initial announcement, followed by sustained directional movement as the market reprices rate expectations and adjusts positioning in Canadian dollar pairs. Dollar Canada and Euro to Canadian dollar. The Bank of Canada's overnight rate decision is out today, and this is a critical event for Canadian dollar traders. The overnight rate is the interest rate at which commercial banks lend reserve balances to each other, and it's the foundation for all other interest rates in Canada's economy. With a forecast matching the previous level at 2.25%, we need to watch closely for any forward guidance that could signal future policy shifts. The overnight rate is the policy rate that the Bank of Canada uses to control monetary conditions and inflation across the entire economy. When the central bank adjusts this rate, it influences everything from mortgage costs to employment levels, making it one of the most important tools for steering economic policy. If the BOC holds rates steady as expected but signals hawkish commentary about future hikes, that could strengthen the Canadian dollar because higher rates attract foreign capital seeking better returns. Conversely, dovish guidance suggesting rate cuts ahead would weaken the loonie, as investors would seek higher yields elsewhere. The recent trend shows the BOC has been data-dependent, closely monitoring inflation and labor market strength, so traders should listen carefully to the statement and any commentary about economic momentum. Watch for the language around inflation progress, employment resilience, and global growth outlook. These are the key drivers of what happens next. Price action traders should be ready for sharp moves in the minutes following the announcement, with volatility likely to extend through the following sessions as markets digest the implications. We're watching Fed Chairman Warsh take the stand for testimony today, and this is a high-impact event that could shake currency markets. Warsh's comments on monetary policy, inflation, and economic growth will give us real insight into the Fed's thinking as we head into the next policy decision. Since the dollar tends to react sharply to Fed communication, traders across all major pairs need to be tuned in. When the Fed chair testifies before Congress, they're essentially laying out the central bank's policy framework and economic outlook for the entire world to hear. These comments directly influence expectations around interest rates and quantitative tightening, which are the primary drivers of dollar strength or weakness. If Warsh signals a more hawkish stance, emphasizing inflation concerns or the need for higher rates, we typically see the dollar rally across the board as traders price in tighter monetary conditions. Conversely, dovish commentary suggesting patience or rate cuts would weaken the dollar. The market context matters too. Traders will be comparing his tone to recent Fed communications and economic data to gauge whether the Fed is pivoting or staying the course. Watch for specific language around inflation persistence, labor market resilience, and the terminal rate outlook. Price action in the first hour after testimony concludes is typically the most volatile, as algorithmic traders and institutional desks rapidly reprice. We're looking at the Bank of Canada press conference today, and this is a critical event for the Canadian dollar. The BOC will be communicating its latest monetary policy decision and economic outlook, which can trigger significant moves across all major US dollar, euro, sterling, and Aussie pairs against the loonie. This is a high-impact event that Forex traders need to pay close attention to. The Bank of Canada press conference is where the central bank communicates its interest rate decision, economic assessment, and forward guidance to the market. This matters enormously because interest rate expectations are one of the primary drivers of currency valuation. Higher rates attract foreign capital seeking better returns, which strengthens the Canadian dollar. A hawkish surprise, where the BOC signals higher rates or slower rate cuts ahead, would typically support the Canadian dollar across the board, while a dovish surprise would weaken it. Conversely, if the BOC sounds more cautious about inflation or growth, that could trigger Canadian dollar selling. Traders should watch for any shifts in the BOC's tone on inflation, the economy's resilience, and their forward guidance on rates. Price action around support and resistance levels during and immediately after the conference can be volatile, so watch for breakouts or reversals that signal where the market is repricing Canadian monetary policy expectations. Dollar Canada and Euro to Canadian dollar are your top two pairs to monitor. Dollar Canada is the most liquid. We're looking at Japan's tertiary industry activity data for the month, which measures the health of the service sector, everything from retail to hospitality to finance. This is one of the key indicators traders watch to gauge overall economic momentum in the world's third largest economy. The forecast is showing a slowdown to 0.4% month-over-month, down from the previous 1.3% reading. That's a notable deceleration in service sector growth, though with low impact classification, we shouldn't expect dramatic market swings. The yen may see some modest pressure if this confirms economic softening, but broader dollar-yen momentum will likely remain driven by larger macro factors. We're tracking the Eurozone industrial production report for this month, which measures the output from factories and manufacturing across the euro area. It's a moderate impact economic indicator that gives us insight into the health of Europe's industrial sector. Today's forecast is showing a 0.3% month-over-month increase, slightly higher than the previous 0.1% reading, which would suggest a modest uptick in manufacturing activity. However, with this being a low-impact release, we're likely to see muted market reaction unless the actual print comes in significantly different from expectations. Traders will be watching this more as a data point on the broader economic picture rather than a main. We're looking at China's M2 money supply data this session, which measures the total amount of money circulating in the Chinese economy year over year. While this is a lower impact release, it still gives us insight into Beijing's monetary policy stance and overall economic health. The forecast is calling for an 8.5% reading, down slightly from the previous 8.6%, suggesting a marginal tightening in money supply growth. This modest decline is relatively minor and unlikely to trigger significant volatility, though traders watching Chinese economic data will note any deviation that might signal shifts in central bank policy or economic momentum. Based on today's releases, the pairs most at risk of volatility this session are dollar yen and euro yen and pound yen. Here is a breakdown of why each pair is in focus. That wraps up the complete daily Forex news economic calendar breakdown. The key theme today is yen volatility across major currency pairs. Keep a close eye on the release times. A surprise deviation from forecast is often where the real moves happen. This is educational content only. Trade safely and manage your risk. Thanks for tuning into Pip Insight Macro. Don't forget to like, subscribe, and hit that notification bell. Follow us on X at @ForexInsight for real-time updates. See you next time.